You might be leaving thousands of dollars on the table every single year without even realizing it. Let's say you earn $60,000 a year. If you aren't contributing to your workplace retirement plan, or if you're contributing but missing out on your employer's match, you could be losing out on between $1,500 and $3,000 annually. Over a 30-year career, that's not just a few $100. That is hundreds of thousands of dollars gone. Gone. Hi everyone, welcome back to Fiscal Beacon. I'm your host, and today we are stripping away the confusion around one of the most powerful tools in personal finance, the 401k. If you have a job that offers a 401k, you have a golden ticket, but like any ticket, it's only valuable if you know how to use it. In this video, we're going to explain exactly what a 401k is, why the employer match is non-negotiable, how taxes play a role, and how to pick investments without getting overwhelmed. We'll keep it practical, clear, and free of Wall Street jargon. By the end of this, you'll know exactly what to do with your next paycheck. So, what exactly is a 401k? The name comes from a section of the Internal Revenue Code, but you don't need to memorize that. Simply put, a 401k is a retirement savings plan offered by your employer. It's a tax-advantaged account that allows you to set aside a portion of your paycheck before taxes are taken out. This money is then invested in a selection of funds chosen by your employer. The key here is the word automatic. Because the money is taken directly from your paycheck, you never really see it. This makes it incredibly easy to save consistently without having to manually transfer money from your checking account every month. It removes the temptation to spend what you don't see. Now, let's talk about the single most important reason you should care about this account, the employer match. Think of an employer match as a 100% return on your investment. Instantly. There is no stock, no crypto, and no savings account that can beat that. Let's look at a real example. Imagine your employer offers a 50% match up to 6% of your salary. This sounds complicated, so let's break it down. If you earn $60,000 a year, 6% of that is $3,600. Your employer will contribute 50% of that amount, which is $1,800. Here is the catch: you have to contribute enough of your own money to trigger that match. If you only contribute 3% of your salary, your employer will only match 50% of that 3%. You leave half the free money on the table. So, what should you contribute? The general rule of thumb is to contribute at least enough to get the full employer match. If you can afford more, even better. But never leave free money on the table. If your employer doesn't offer a match, that's a different conversation, but if they do, treat that match as part of your salary. It's your money. Next, we need to talk about taxes. This is where things get interesting because 401k's come in two main flavors, traditional and Roth. With a traditional 401k, your contributions are made with pre-tax dollars. This means the money goes into the account before income tax is calculated. So, if you earn $60,000 and contribute $3,000 to your traditional 401k, you are only taxed on $57,000. This lowers your current taxable income, which might put you in a lower tax bracket and reduce your tax bill this year. The trade-off: when you withdraw the money in retirement, you pay income tax on both your contributions and your earnings. On the other hand, there is the Roth 401k. With a Roth, you contribute after-tax dollars. You pay taxes on the money now in your current paycheck. However, because you've already paid the tax, all your future growth and withdrawals in retirement are completely tax-free. So, which one should you choose? It depends on your outlook. If you believe your tax rate will be higher in retirement than it is now, the Roth is often the smarter bet. If you think your tax rate will be lower in retirement, the traditional 401k makes more sense because of the immediate tax break. Many people choose a mix of both to hedge their bets. If you're unsure, look at your current tax bracket. If you're in a high bracket now, the traditional might save you more money today. If you're early in your career and in a lower bracket, the Roth could save you more in the long run. Always consider consulting a financial advisor or a tax professional to help you decide what's best for your specific situation. Once you've decided how much to contribute and which type of account to use, you have to decide where that money goes. This is where many people get stuck. When you open a 401(k), you are usually presented with a list of investment options. These are typically mutual funds or ETFs. You don't buy individual stocks like Apple or Tesla directly in most 401(k)s. You buy shares of a fund that holds many stocks. The biggest mistake people make here is picking hyphy funds or trying to time the market. Let's talk about fees. Every fund has an expense ratio, which is an annual fee charged as a percentage of your investment. A 0.5% fee might not sound like much, but over 30 years, it can eat up a significant portion of your compound interest. Look for low-cost index funds. These funds track the overall market, like the S&P 500, and usually have very low fees. You want to keep your costs low so your money can grow. Another common error is putting all your eggs in one basket. If you put all your money into a single company's stock fund, you're taking on a lot of risk. If that company fails, you lose a lot. A good strategy is diversification. A simple, effective approach for many people is a target date fund. These funds are designed to become more conservative as you get closer to your retirement date. If you plan to retire in 2055, you might choose a target date fund for 2055. It automatically adjusts the mix of stocks and bonds for you. It's a set it and forget it option that works well for busy people. Now let's address the elephant in the room. What happens if you need the money before retirement? The short answer is, try not to. The 401(k) is designed for long-term growth. If you withdraw money before age 59 and a half, you generally have to pay a 10% early withdrawal penalty on top of regular income taxes. That is a steep cost. However, there are exceptions. For example, you can usually take a loan from your 401(k) under certain conditions, but you have to pay it back with interest. If you leave your job, you can roll over your 401(k) into an individual retirement account, IRA, or a new employer's plan without paying taxes. This is called a rollover. It's important to handle this correctly so you don't trigger a taxable event. If you're changing jobs, don't just leave your old 401(k) sitting there. Review the fees and performance. If the fees are high or the options are limited, rolling it over to an IRA might give you more control and better investment choices. Let's recap what we've learned. First, a 401(k) is a workplace retirement savings plan that helps you save automatically. Second, always contribute enough to get the full employer match. That is free money and a 100% return. Third, choose between traditional and Roth based on your current and expected future tax situation. Fourth, keep fees low by choosing index funds or target date funds and avoid trying to pick individual stocks. Finally, avoid early withdrawals unless it's an absolute emergency, because the penalties are harsh. So what is your next step? Open your company's retirement portal or log in to your HR dashboard. Check your current contribution rate. Are you getting the full match? If not, increase it immediately. If you are, review your investment selection. Are your fees reasonable? Is your portfolio diversified? Make one small change this week. That's it. You don't need to become an expert overnight. Just start. If you found this explanation helpful, please give this video a thumbs up and subscribe to Fiscal Beacon. We break down complex money topics into simple, actionable steps so you can build wealth with confidence. In our next video, we're going to talk about IRAs, specifically the difference between a traditional IRA and a Roth IRA and how they compare to your 401(k). You won't want to miss it. Remember, this video is for educational purposes only and does not constitute financial advice. Always consider consulting a financial advisor for personalized guidance tailored to your unique financial situation. Thanks for watching.